Let's welcome in Diane King Hall, host of Morning Movers, and we're shifting from the macro to the micro, and you're looking at Zscaler this morning, down, under pressure. Yeah. What gives there?
I mean, what's interesting to see is it initially popped, but then it took a step back. So we'll be watching how this one plays out throughout today's session, because it did perform better than expected, and the street had liked the guidance, and you're seeing some, constructive commentary from the analyst community, but it has been an outperformer year to date compared to the S&P 500. So let's go through these numbers. Adjusted EPS came in at 89 cents a share. Again, the stock had initially moved higher off the back of its results, but it's taking a step back now. Shares are under some pressure. Revenue topped $719 million. That's a jump of more than 20%, and that beat expectations. So they made more money, they sold more services than expected. In terms of their outlook, for their 2026 forecast, they're projecting sales of more than $3.25 billion. That's higher than what Wall Street is looking for. The guidance for the next quarter also higher than expected overall. So, keep in mind for Zscaler, this is, they go head to head with, say, Palo Alto, others in this cybersecurity space. They emphasize their ARR is improving, annual recurring revenue. You know that figure well. It hit $3 billion. That's up 22% from a year ago. They have more strength to come. They're adding contracts month by month and quarter by quarter there. Part of this has to do with the proliferation of AI. It's both a boon and it's a challenge for companies, but it creates opportunity for a Zscaler. Hackers using AI to launch smart attacks. Companies that need Zscaler to, beef up their defense, right? And Zscaler is actually leaning into AI with regard to its defense. They also had that recent acquisition of Red Canary that expands it into what they call managed detection and response. It's a fast-growing market where AI helps companies fight threats. So you need AI to beat AI, essentially. In terms of the stock performance, before today, the stock was up more than 50%. So this may be some profit taking here, Sam.
Yeah, it could be a bit of a sell the news type event or something, because, to your point, it has been an outperformer very much a year to date. We've seen also the market sort of punishing prudence and imperfection, particularly when it comes to the guidance, even if you do clear the bar. But suffice to say, it's still earned itself a number of price target adjustments out from the analysts on the street. I'm seeing them coming in. There's a shopping list. I mean, more so to the upside as far as raises here. The likes of JP Morgan, Piper Sandler, I'm seeing KeyBank as well. So to run us through what the analysts are saying off the back of this report card.
So Baird outperformed. They've raised their price target to 345. So very constructive here. KeyBank maintaining overweight, equivalent of a buy rating. They're raising their price target to 350. Stifel is a buy on this. They're maintaining a buy on Zscaler. They're raising their price target to 330. So they see upside from here. Piper Sandler is on the sidelines. They're staying on the sidelines. They're still neutral on Zscaler, but they are raising their price target, so there's something to be said for that. They're raising it to 280. You got JMP Securities. They are market perform on that, so they're on the sidelines as well, but they've got a $355 price target on, which signals upside from here, even if you take into account that outperformance year to date. RBC is raising their price target to 335. They are keeping an outperform rating. Rosenblatt's got a buy rating. They're raising their price target to 330. So you see the theme here, Sam. It's, bar clear in the view of the sell side. So again, this may be a sell the news event.
Yeah. And a very surprisingly opposite direction of the next two that you've got coming up. I'm just wondering, why we're seeing this movement, Macy's versus Dollar Tree. Start with Macy's first, because I suppose that was a little bit of a surprise to the market.
Much better than expected. Yeah. Consumers really like, I guess, what is happening at Macy's. So they did better than expected in their most recent quarter. Macy's needed this win. They've been really trying to work on this turnaround. So adjusted EPS, 41 cents a share. Handily cleared the bar. 18 cents is what the street was looking for. Revenue, $4.81 billion. So that was also a beat. Comps improved. You saw comps rise 0.8%. That's a key metric, and it shows that's the best growth in 12 quarters for Macy's. So it's been a part of this turnaround that CEO Tony Spring has been working on, this what he calls a bold new chapter. Look, does Macy's have some tariff risk? Yes, but they are working to manage that. Where you saw strength was really across the board. Bloomingdale's remains, one of their key pillars there. You saw growth of more than 3.5% for Bloomingdale, so it held its own. But you also saw strength in Bluemercury and the Macy's Reimagined stores. So that's something to be said, especially for the Macy's Reimagined stores. You saw 1.1% growth there. Bluemercury 1.2%. Again, the comp sales growth, best in 12 quarters. That's driven by growth in denim and women's contemporary and watches.
Okay.
Not surprised. I went into a Macy's recently and I noticed their assortment. It just looked better.
Right.
So there's something to be said for that, meeting the bar of what consumers are looking for. They did increase their forecast off the back of this. Again, they talked about the tariff challenge, but they're managing that, and they're reducing their exposure to China as well to manage that risk.
Diversification is key. And I mean, to your point, I went into a Macy's store yesterday actually looking for a product which they said they didn't carry. It was actually carried by another store, which is interesting. But I mean, that was just my experience, just one example. But it's all about tariffs with Dollar Tree too, as far as tariff timing, they were saying as well. It seems to be a bit of a case of front loading there. I'm just wondering what you're seeing with that report card.
Yeah, so look, it is a tale of two retailers today, but again, Macy's, you take the win. It's up more than 20%, and it needed that win because it had been down around that amount year to date. That could potentially take it to neutral by the close of today's session. We'll see. Dollar Tree is off by 8% roughly off the back of its results, but that has been a strong outperformer year to date. Before today's move, I think the stock was up like, say, 40% or so, give or take there. They did beat expectations, but it's all about what have you done for me lately? What's coming next, right? And their guidance, and it's more about their guidance for the third quarter that has the street a little bit concerned today, because this trailing quarter, adjusted EPS, 77 cents a share. That was a big beat and the biggest margin of beat in several quarters for several years, actually. And then you saw sales increase as well, revenue jumping more than 10%. Topping $4.5 billion. So that was a big increase. Comps up 6.5%. But again, it's the guidance that matters. Q3 guidance, they're expecting EPS to be flat year over year. That is well below consensus. The street was looking for double-digit growth there. Now, they did raise their full-year adjusted EPS. They're expecting that to come in between $5.32 to $5.72. Full-year sales, they're expecting that to come in between $19.3 billion to $19.5 billion. That's actually better than what the street is looking for, and they boosted their full-year comp sales forecast to between 4% and 6%. But again, they talked about tariffs and the timing of that, and so that, hence the Q3 guidance weakness there. But overall, I mean, look, it's not a bad report card for a Dollar Tree, and they have been an outperformer year to date, not performing on the day off the back of their quarterly results like Dollar General did.
Yeah.
But again, it has been beating Dollar General year to date. Today's move is going to take it around the same, probably, actually.
I was going to say, I mean, there just must be so much scrutiny on these types of businesses when you look at a company like Dollar General v. Dollar Tree, because, we saw some strong earnings from Dollar General, and that is because they're very much a beneficiary of those consumer trends, value-hungry seeking consumers right now.
That's right.
So, it's an interesting move.
And it is. And what it's also interesting is they are having a different year this year than last year, because the expectation was that last year they would benefit from the choosy consumer. We didn't really see that last year. It was really about Walmart. Walmart's still a winner this year because Walmart has shown strength, whether you've got a weakening economy, and then they've maintained the sticky consumer base of the higher income shopper. Dollar Tree and Dollar General this year started to see some shift of consumers choosing there, and that's when you can see that in their share performance. But again, Wall Street clearly disappointed with Dollar Tree and their forecast for Q3.
Yeah, and there was a caveat in Macy's outlook as well, with that fickle consumer too. So, it's been interesting as far as, how companies are looking at the consumer right now into the future. But, they don't have a crystal ball, that's for sure. Thank you so much, Diane, for getting us across those key stories at this morning. Diane King Hall there.